At this point, I've said so many times, risk and risk tolerance is maybe the fundamental component of investing because risk tolerance indicates what asset allocation you should have. Now, in general, higher risk means the higher potential return, but also the potential to lose money. In general, at least if we've assessed the risk correctly. If you're young, you have the room and time to make riskier investments before retirement because retirement is further away, unless you want to retire early. We have a clip on that as well. If you're soon retiring or already retired, your tolerance for risk may be much smaller. Also, the money you have to work with may be something you need to access in the short term, for example, to buy a house. That's also a consideration when it comes to liquidity and the risk of investment. So we're going to have a conversation about different asset classes and types of investments and kind of rank them based on risk. And if you're buying one, you should know what is the level of risk that you're taking on. Now, a couple of things to mention. We're going to be talking about cash, stock index funds, individual stocks, bond funds, bonds, real estate, crypto, metals, and gambling. There are other asset classes. And the other thing is we're going to talk about the absolute risk. And you're going to see what I mean in a moment. So let's start with the least risky, lowest risk, lowest reward. We are talking, of course, I'm sure you all know. Hold on, let me get this up on the screen. Here we go. We're talking about cash. Okay. Cash is at the bottom. It's the lowest risk and it's the lowest reward because of something called FDIC insurance. Now, I know many of you are going to say, David, cash has a huge risk, inflation risk. If you have cash earning 0 or 1% and inflation is 8%, you're losing 7%. That's terribly risky. We're talking about the absolute volatility and risk. And of course, inflation can affect all of these. We have to do that in order to be able to kind of compartmentalize this conversation. Cash in you always want to do a high yield savings account, is my opinion. Right now, there are high yield savings accounts paying, I know of 3.25%. That is actually really good because we have a higher interest rate environment. You can get more money for your cash. That is an advantage. Cash can also go in CDs. Sometimes it's a money market account. You know that nominally the money isn't going to shrink. You have FDIC insurance up to $250,000 per account. So opportunity cost aside, inflation cost aside, there is almost no risk here. The downside is there's the chance of making more than just a couple percent when the money is deployed in other assets and over long periods of time, and then you potentially can mitigate the inflationary risk as well. Beyond this, it's probably individual bonds, but you have to be specific about which bonds, okay? When you go up, a top-rated individual bond, something like, for example, the U.S. has never defaulted on its bond debts, as an example. So we might say USA. There are other countries that have never defaulted on bond debts. That's probably the next possibility in terms of going up in terms of risk. After individual bonds, it's probably a bond fund. And the reason I say probably is specific environments can change the risk level over short to medium term periods of time. But we're talking about generally. The reason why a bond fund is usually riskier than an individual bond is because instead of knowing what return you will get, with an individual bond, you know the return. You're subject to bond market risk, and the bond fund value could decline if interest rates go up, since newly issued bonds will be better deals. So even though bond funds are relatively lower risk compared to some of the other investments we'll talk about, it's important that there's still a risk. In 2022, US-based bond funds are down something like 15%, historically unusual, and it's a historically bad year. The return you can hope for over the long term is a few percent, generally speaking. Now, it starts to get controversial. What is next? I think you can make the case that metals are next, precious metals, gold, silver, etc. Historically, the return of gold has been lower than on stocks over the long term. Often you're talking about like 4 to 5%, okay? But there can be volatility. There's arguments that metals have an intrinsic value that certain other assets don't have. Precious metals can become extremely contentious, but taking a sort of objective, detached approach, you're probably talking about more risk with metals than bond funds and individual bonds, but arguably less than a stock index fund, which would be the next thing. Oh, hold on, I messed that up. Stock index fund. Stock index funds, you're taking on a little more risk. A stock index fund, as I've talked about before, can track the S&P 500, or it can track, the Russell 2000, or you could have a total market index. In general, this is assigned like 7%. If you stay in it for the really long term, you're going to earn 7% a year. You can have years where you lose 30%. Okay. So risk and volatility are absolutely higher. Now, this gets tricky. Is real estate next? Well, it depends on your perspective. This is tricky because in addition to being an investment, you could be talking about real estate as a primary residence and you're getting a place to live. But in this context, we really want to think more about it as buying like a REIT, a real estate investment trust, or purchasing an additional home, which you might rent out or make an income property. Housing market is known for booms and busts. There is risk from the overall economy when it comes to real estate. There's interest rate risk when it comes to mortgages on real estate. There are regional issues where some parts of the country do better than others. Sometimes you hear people talk about a 10% return. It is way more modest. The reality is it is way more modest, particularly if you have a mortgage on the property. And what people often don't consider, I recently had a conversation with someone. They said, oh my goodness, my parents, they bought a house for 120 grand 30 years ago. They sold it for 1.5 million. Okay. So it looks like 1.3 million in profit. First of all, what did inflation do to that over that 20 or 30 year period? Secondly, they had a mortgage. Mortgage payments are overwhelmingly interest at the beginning. What is their total of payments over that period of time? What did they pay on real estate taxes, et cetera? So where exactly real estate goes is sort of controversial. What helps to mitigate the risk of real estate is typically people buy property with the intention of holding it for a long time, which means it can recover if the market crashes. All right. Next, in terms of level of risk and volatility, is individual stocks. And I think I should say, you could make the case that real estate maybe should be below stock index fund. This is not cut and dry. It's sort of a spectrum. Individual stocks, much more risky. I believe money you put into individual stocks, you should be prepared to lose, maybe even all of it. Companies go bankrupt all the time. Individual stocks give you the opportunity to double, triple your money. I think, as some of you know, I used to own Tesla stock. I think my average return on Tesla stock was 1,600%. But how many of my investments didn't do anything or even lost money during that period of time? Investing in companies like Apple and Google is going to be safer than many small cap companies that no one's ever heard of on average. But if you decide to put money in individual stocks, you should expect to get a much larger return to consider it a good investment to make up for the additional risk that you are taking. And then at the top, we could have something like crypto. Crypto is super volatile. It's new. I'm sure most of you know how risky it is. Bitcoin is the most well-established crypto, and it has massive swings. In 2020, it was up 300%. 2021, it went up 60%. In 22, it's down 67%. It would have to quadruple from its current price to get to an all-time high. There are altcoins that are even riskier than Bitcoin. This is why I've said before, I've only ever had 3% of my assets in crypto. During those huge upward swings, I would keep selling back down to 3% to lock in my gains, and I still have only 3% there now. And then maybe like even beyond this, we could mention gambling. When you look at the expected return on gambling, it's sort of like one of the riskiest things you can do. Playing the lottery, betting on sports. You could lose all your money. There's the addiction risk. There's all sorts of other things. If you hold a stock or crypto and it goes down a lot, you still have the shares or the coins unless they go completely bankrupt. And someday it can recover. With gambling, the money is just gone. This is a general framework. You can argue with it. You can disagree with it. But it's a good initial framework to think about risk.